All right, the stock market finished the week keeping its winning streak alive. 4 days in a row on the S&P, 4 days in a row for the Nasdaq, above 1%. But under the surface, there are some cracks that are starting to show. The S&P 500 both posted some solid gains, again fueled by big surges in tech and the Mag 7 names, especially from Google with its earnings. Nvidia had a great day, but over half of the market actually finished lower, hinting that not everything is as strong as it seems. With earnings seasons heating up, trade tensions simmering somewhat again, today's action tells a more complicated story than just, hey, there's green on the screen everywhere. In today's market outlook, we'll break down what's really driving this rally, where the hidden risks are building, and what it means for your next trading move. So let's go ahead and get started. Today is Friday, April the 25th, 2025. This is the market outlook from marketscholars.com. My name is David Settle. All right, before we get going too far, I invite you to subscribe to our YouTube channel with this icon here, the red subscribe button down below. Click the thumbs up icon to like our video. Comment on anything that stood out to you today. Join our website at marketscholars.com for free. Follow me on Twitter for more content between the videos. And join our Market Outlook Facebook group that we've created. All right, if you're watching us here on our blog, check out some of these other things on the page, including on the right. You can sign up for our email list right here. Watch our Market Outlook live video. This is a live stream I do every day right before the market closes. We review all the old Market Outlook trades we've done in previous videos. We also put on today's Market Outlook trade before the market closes. Come down to the bottom, click on this. You can see some other links that you can click on over here. And then at the bottom, click on this heart. It opens up this tab. Hit that like button that pops up there eventually. There we go. Hit that like button there. Same thing here. Click this thumbs up icon. It opens up this tab. Come down and hit that like button. Again, the more you do that, it helps get our content out to all of our followers on these platforms. So thank you to those who do that every day. Those who don't, you can do it right now while you're watching with one or two really easy clicks. All right, let's start off taking a look at the S&P 500 with the market forecast indicator here. As you can see, the rally we had today is 4 days in a row now that we've had to the upside here. And now with yesterday's move, we did close above the high point on April the 9th. We closed at 54.84. The high point there is 54.81. So we kind of closed above there. The gap here at 54.99 was an important level that we did not get above there. But today we did break into it. Now granted, less than half of the range. The range is getting smaller, but still at pretty high levels. And this was a very, very small range, but regardless, the near-term line did, get above the 90th percentile, got all the way up to the 98th percentile. The momentum line, however, is not down. I'm gonna make quite a few comparisons here to May of 2022. So here we go. Back in May of 2022, you can see that we actually had a drop below the 40% on the 10-day exponential moving average of the advancers relative to total issues in the New York Stock Exchange. So this is this wide breadth thrust that we've heard so much about. And we got up to, by May 27th, which is day 10 of that period, we got up to 60%. So it didn't quite get to 61.5. You can actually see it better on this chart. This actually shows the moving average. This graphs the moving average there. So if I were to go back to 2022 here, there we go, and then look at 2022. There we go. So there's the average right there. So we were below 40% in May. I got below 40% again, but we never did get below 61.5%. Over here, we got up to, by May 27th, we got up to 64.7 there. So it's actually May 26th was day 10. So the next day we did get up to 64.7, but that wasn't 10 days. So if you look at this here, we start off, the last day was May 12th. So May 13th is 1, 2, 3, 4, 5, 6 days going through the end of that week. 7, 8, 9, 10. So not quite the breadth thrust, but on day 11 we got the 60% on day 10. Day 11 we got the 64.7. So not perfectly as wide breadth thrust, because It's got to be above 61.5% or 61.5 or more on day 10. So we were just below 61.5 on day 10, and we were well above it on day 11. So if I were to go back to the market forecast chart and take a look at that time frame of May, we'll all go back to the 27th of that year, and we'll go here May. Now take a look at this chart that you see right now. This is the current market forecast chart. And you kind of see what we're seeing. This is what it looked like on that day, right? On that day that we got that, what would be this white bread thrust if it was an 11-day period instead of a 10-day period that we had to get to 61.5. You can see we got up. We got the bear tag. We got a really strong run. Look at the near-term line, getting well above the 90th percentile. The momentum line did not get there first. The intermediate line was not above 50 like it is now, so you only have light green shading. But again, look at that period now and look at this one, and it looks very similar, except for the dark green shading because of the slightly higher intermediate line. But the near-term line getting to strong highs, the momentum line without it. And again, you're not very far. We were 0.79% there in May. We are 0.96%. Remember, you have to get about 2.5% to signify that the trend is kind of done here. We do have dark green shading and a green line. The moving average is turning higher. We've been, like close to the moving average, close enough that the 30-day average now is actually higher going into Monday than it was today. So dark green shading and a green line as of right now. You take a look at the Nasdaq 100. It looks very similar. Take a look at the Dow Jones Industrial Average. Not quite the same, right? We're not above the moving average. The near-term line is not above 80. So, we're still not quite there, right? The intermediate line is above the near-term line. Look at the Dow Jones Transportation Average instead of just the industrials. And it looks even worse, right? The near-term line is not even close to getting above 80. The intermediate line also still in bearish territory, and we're still almost 4% below the moving average. Then finally, if I take a look at the Russell 2000, right at the moving average, again, not getting above it, no yellow line. Intermediate line's rising, light green shading, but not above 50 yet. Near-term line above 80, but not as strong as what we saw on the S&P 500 and the Nasdaq 100. Let's go back to the S&P and take a look at its weekly market forecast chart, because we had a great week this week. There it is there. You can see we have light green shading because the intermediate line turned higher, and your near-term line here, take a look at this. Remember, it's got to cross 40. So here, this was period 1 of it crossing 40, and the momentum line actually finished the period. So it crossed 40 and 50, but the momentum line actually closed below it. So this would be period 2 that we would need it to cross above 80, and it, obviously it hasn't crossed above 80 yet, and the momentum line still in neutral levels. At least it's bullish enough to get the intermediate line turning higher, and we are 5% below, still a little bit less than 5% below the 30-week moving average. So a good week. So pretty much what we saw here this week. Well, let's get to this in just a second. Let's make sure we get to the other weekly chart here. So again, 2 transition candles, but remember, it can be a reversal candle if it's a bullish candle, and that's a pretty good bullish candle. So there's a good chance here that we end up with a bullish week next week, according to that pattern, right? That singular pattern there. Now you look at the 3 green arrow charts. Obviously, now we have 3 green arrows for 2 days on the S&P, for 2 days on the Nasdaq. We do not have the 3 green arrows yet on the other 2 indexes. Now let's take a look at the 2-line version. And you can see here, at one point in time, we were so bearish that we were more than 11.5%, well, 8.5% below the 8-day exponential moving average. And obviously we've rebounded back up to now we're up to 3%. In fact, we are further above the 8-day moving average than what we have seen for most of the year. We were pretty far up there here too, and then we started to grind, right? We still went up, but we started to grind at that point. The last thing we want to see right now is grinding. But the other way to look at this is, let's look at the weekly chart, and you can see here is where we were 11.5% below the 8-week moving average. And so this 3-week rally that we've had, which is a pretty good, I mean, we had one down week in there, but when you look at this 3-week move that we've had, which is essentially how many days here we have, because we had Easter in there, so it's really only a 14-day rate of change. So sorry, this is not the chart I want to look at. I want to look at the rate of change. I mean, this still, regardless, even for 14 days, I mean, it's not the best 14-day move that we've ever had, but it's still a pretty good one, right? Like you can see here, again, going into, this is Friday, so it'd be the 25th, the 25th, the 18th was a Friday, so we don't have that there, and then the 11th, right? So right in here. So going all the way out to April the 7th. So 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14. 14 days now. This is that 3-week period. We started it with a decline. We started with two declines. Well, we started it with that drop, and then we rallied up by the end of that week there, and then you can see going forward. So again, I am pinpointing this 3-week period right here, right here. This 3-week period right here. So starting on the 7th, right? Starting on April the 7th is when that period started. So it'd actually be starting right there on this low point. So for 8.89% rally. That's a pretty good move for 14 days. You can see it's the strongest 14-day rally we've had in the last year. So that's pretty good. Let's go out to 5 years, and you can see it's not the strongest 14-day rally, but we had a pretty good rally like this coming off that November 2023 low, which was also as wide breadth thrust, right? We also got that there, and you can see some other periods. Here's that May period. We didn't quite get a 14-day period of 8%, but we did in March and we did in August for both of those corrections, and then obviously they failed. And then you can also see coming off of the COVID vaccine low and the presidential election low point there, we also rallied pretty significantly, as well as going into that parabolic move in 2020. So needless to say, like, we had a big 14-day drop, and now we've rebounded with a 14-day rally. And the question is, so I think the biggest impetus for this rally that we've seen is just that we were extremely oversold. Whether it's on a daily basis or on a weekly basis here. This is actually the regular MACD, the 817 that we use. But we were so far below the 8-day. I mean, we're still not even above the 17-week moving average yet. We were so far below the 8-week that we rebounded, right? And the same thing, again, like I said, could be said for the daily MACD. We were extremely bearish, and we've essentially rebounded that extreme, right? It was an extreme oversold technical bounce. Now the question is whether or not we actually can be bullish on our own, right? Without needing an oversold condition to produce the bullishness, right? The strong bullish move. Because every time, like you can see, like you get extremely low on, whatever, indicator you're looking at, you get a rebound, right? You can see we got a rebound there in May, we got a rebound there, we got a rebound here. Like every time the MACD gets low, you rebound, right? That's kind of normal, and this has been a pretty darn good rebound, because you can see the MACD is pretty much almost, the MACD is, the histogram is higher than any other period during the past year. So it's a strong move. We were strongly bearish. It's a strong rebound. Now we need it to be more than just a rebound, right? Now we need it to actually be its own trend, and trend to the upside. And we're not really seeing a lot of the indicators confirming that yet. You can see, like, remember, when we're bullish here, the positive indicators got to at least be above 25, if not 30, and the negative indicators got to be below 20. We're not getting that yet, as bullish as we've been. If you look at the RS, now we're not also as bearish as we were, but we're also not bullish yet. We don't even have the lines crossing each other yet. The RSI and the CCI, if we're bullish, we got to be above 60. If we're bullish down here, we got to be above 100. We're not there yet. I mean, at least 150. We're not there yet. We saw that over here. We got above, we got close to 50, and we got above 100. And that one failed, right? And again, even going out to May 2022, so right in this area here, you can see we also got above 50, and we did get above 150. We got almost above 200, and that still failed. So we're not quite getting what we need to see on these indicators. If I look at the Ichimoku cloud, one thing we did get finally is we finally hit 0 on both of those indicators down below, the trend quality and the trend noise balance. So again, a confirmation that essentially we have ended the bearish trend, this strong bearishness, but we haven't started the bullish trend yet. We're not even weak bullish trend on this. We're still way below the cloud, and the rate of change is still easily negative. Now it's most likely going to go through this area at some point, because I doubt the rate of change is going to get below, because remember the rate of change here is the current close plotted 26 days backwards. So 26 days from now, I doubt we're going to be down here below 481. So at some point in time, the rate of change is going to cross through this area up to new highs. The question is whether we're going to drop down here first before we rally up. We'll see if that ends up being the case. If you look at the Bollinger Bands and the Keltner channels, we are in the upper half of the chart, right? That's good, right? In the upper half of the bandwidth. If you take a look at, again, going back to that May 2022 time frame, you can see we also got up into the upper half of the bandwidth. In fact, we dipped our toe into the upper quartile of the bandwidth. The bandwidth was falling, and then we made that washout move low to the downside. Remember, we've already had our washout move to the downside, but you see, the bandwidth is falling. We're up at the point of control. We're up to the upper half of the bandwidth. If you take a look at where we're at here, the momentum has turned slightly positive. So hey, that's good. The bands are inside the Keltner channels. We are slightly positive momentum. Very, very good sign. Now get into the upper quartile of the bandwidth would be bullish, right? Especially getting up against the upper band. Considering how strong the bandwidth is, it's unlikely we're going to do that. But that would be our bullish sign that we don't quite have yet, right? Taking a look at the intraday move, you take a look at the intraday move and you see, okay, we got above this high point finally. We've been kind of grinding, right? We got up there on Wednesday and then we failed and we kind of got into the gap. And then on Thursday we made another little run up above, and then today we made an even smaller little run up above to higher highs and higher lows. But again, the small range and very low volume. Trying to get into this gap here. We are into it a little bit, but just a little bit with very unbelievably low volume. Again, nowhere near the high point. In fact, when you look at the stochastics here, like we're at the 80th percentile. We're not into the reversal zone. We're not above the 90th percentile, which is where you want to be when you're breaking to a new trend. Now, we're close, right? We're getting close. Like here, we went from 67 to 90. Again, you go back to that May time frame in 2022. So right in here, we also got above 90, right? We got up to 80, just like we did here. We got right up to 80 on this point, and then the low point started to falter, and we were right there, right at 90, at 95, because the high point went from up here to actually this high point. But this ended up being the high point after we hit that 80. But we hit 80 right before that, right there on June 2nd, right after the Zweig Brett thrust, right, where we were just a day off or a little bit short on the day 10 and then well past the number on day 11. But so after that, we got up to 80, and then that's kind of where we halted. That was the high, and that was where we halted. Is that going to be the case again here? Are we going to kind of halt here? And then because eventually, if you look at that rate of change or the high point here, like this is the current high point. That's why the green line popped up a little bit and the range fell, because this is the current high point. So by next Wednesday, like this will be the high point. So if we don't get a new high by next Wednesday, if we don't get up past 570 around there by next Wednesday and get a new high ourselves, then this will be the new high. And so we'll see, that can impact, where we're at in that range, right? Whether or not we're in the 90th percent range or not. But, getting a new 4-week high point usually gets us up above 90, and obviously that's not the case yet here. Again, strong, when you're breaking moving averages like this, when you've got, when you're breaking resistance, when you're breaking into strong resistance levels, like you want big ranges and big volumes. Well, the last 2 days, the ranges have been really small, and today being the smallest. Yesterday was 11.98. Today it's 7.36. And then you can see the volume for 2 days in a row is really small. And that's mean, that's great. Eventually that's going to happen because, when these lines are falling, that's bullish. But usually those lines start falling after we've reestablished, after we've broken through the moving averages, after we've broken through resistance. And remember, we've got to break through resistance. Like, we've got those moving averages, which are acting, but the point of control, like, we're breaking the point of control here. We need to be breaking that point of control with strong levels of range and volume, and that's not the case today, right? That's not the case today. And I shared with you this a couple of days ago. The VIX is down, right? The VIX is down below 25, so that's a good sign. And the VIX is below 100% relative to the VIX 3M again. Still at bearish levels because you got to get below 95 to get out of bearish territory. Bearish for, obviously risk appetite. But look at the VVIX. The VVIX dropped below 98, and that's the thing I shared with you before. The VVIX on that 11-day drop. Here, let's go rate of change. So I shared with you this before, that when the VVIX drops, this was going into yesterday, I think is when I talked about this. It was down 40% yesterday, and I even tweeted this out yesterday. If you follow me on Twitter, you would have saw this. 40% drop. Like, there's been only 2 other times in this index's history that we've dropped this much or more in 11 days. Right now, 12. If you look at it now, 12. If you go one more, this is the biggest 12-day drop of the index's history. 42%. That's a tremendous drop, right? If I go, because this index hasn't been around forever, so if I go out to maximum available, this is the biggest drop. You can see there. We haven't had a 12-day drop like this. So, but you go to those other 2 days, and both of those other 2 days, when the VVIX drops this far, this fast, the VIX jumps up over the next week to 2 weeks. The VIX jumps up, and both times jumped up 60% up to its intraday peak from the close of this day. This would be day 0, or yesterday technically would be day 0. 60% run in the VIX to the upside. And what I mentioned yesterday was that's a move up to 43 on the VIX. I don't know if any of us are ready for a move of the VIX up to 43, but that's what that big of a drop does to the VIX, right? A big drop in, so think about, like, when the VIX drops really low to low levels really fast, generally there's, you think, okay, well, there's going to be a rise in volatility. The VIX is going to rebound. Well, when the VVIX drops really low, then you got to now start looking, okay, the S&P or the VIX itself is going to rebound because the VVIX has dropped this far, this fast. So again, you look at this signal, this wide breadth thrust. It's got everybody thinking loaded up right now. Because we're breaking through resistance, 30-day moving average, point of control, but we're doing it with very low volume, very small ranges. None of the indicators are showing breakout signals. None of the other indicators that we look at are showing bullish breakout signals. Like, it does not look like your typical breadth thrusts where we were strongly bearish, and we know that the sentiment's still strongly bearish, right? When you look at the AAII survey back here, you can see we are still strongly bearish. Again, for some context on that May 22nd time frame right there, there's where May 22nd was. So we were relatively bearish there too. Not as bearish as we are now, but the big difference here is how strongly bearish we are all of a sudden. Like, there's a huge gap between the 10-week and the 40-week that we've never seen before on this survey. This is the biggest gap between those two averages that we've seen. The biggest bearish momentum that we've seen. So, we're not going to get more bearish sentiment, but it's also not strongly bullish sentiment either. It's hard to change this, as we saw in 2022 and as we saw in some other instances. It's hard to change this sentiment overnight. In fact, it couldn't do it in 2022. We had another leg lower in October when we had the washout move in June. Over here in 2008, we had a big washout move in 2008 of bearishness, and then we retested it in March, right? So it's not easy to reverse this strong of a sentiment. You've got to change a lot of people's minds, a lot of people's psychologies right now. And this kind of move that we've had here doesn't look like it's been strong enough of a move to change people's mentalities. Again, with how small it has been, and how low the volume has been, and again, how not bullish a lot of these indicators have been, right? They're reflecting the fact that, as great as this move has been, it hasn't been trend changing. It's just been basically correcting what was a pretty darn strong oversold condition. Let's talk about what's driving this price action. Obviously, tariffs have a big deal. Trump and his tariffs that he's had has produced a lot of the weakness. And really, it's been the lack of Trump tariff news that has helped propel this week higher a little bit. We're not firing the Fed chief, and we're not, maybe we're going to start to have some talks with people and get some deals done, and things going to rally. So that's been really helpful for the market, not having any tariff news to help drive the market. If I take a look at the asset class comparison chart, the other big reason for today's move is this week's move, sorry. Here, let me move this way. Is the fact that the dollar is not so bearish anymore. We started off weak in the week. By the end of the week, we rallied. In fact, again, let's just go to the last 4 days. You can see the strength in the dollar, right? And look at gold dropping off. I was sharing a chart on gold here earlier in a class. Look at that big old long upper shadow on gold. That's a big old long upper shadow after a parabolic move. Those tend to be pretty darn bearish. So it's looking like gold is not going to last very much longer in this bullish trend, partly because the dollar, which has been so bearish here, might ultimately have a little bit of a bounce up to the upside. And I think that's probably your biggest reason this week that we've been as bullish as we've been, because the bearish dollar hasn't been as bearish. Now, granted, that doesn't mean that the dollar can't go down more eventually, but as of right now, we're so strong in the momentum to the downside that it's not going to stay that way for a long time. You're going to get a reversal, and that's what we had this week. We also had a reversal this week in our yields, right? Yields, which have been so high. Look at that drop in yields. We had a pretty good drop in yields down to eventually 4.2% after starting the week at 4.4, dropping back down 14 basis points there. That's a really good factor. If you take a look at commodity prices for the week, you can see they kind of held steady, right? A little weak, but pretty much held steady and still below moving averages, still below the point of control, still below the value area. Not just on the daily chart, but if you look at the weekly chart, same thing, right? Still below the point of control, still below the 200-week moving average. So, like, crude oil remains in its own kind of bear market right now. See, well below the 200, has been below the 200-week moving average for a long time. Still well below these levels at 63. Like, that's a depressed level of commodities and crude that a growing economy typically wouldn't have, right? Typically, a growing economy, these higher growth expectations in the economy coincides with rising crude oil prices, and that's not necessarily what we're seeing here. But the big move is the dollar, right? Getting the dollar off of those lows, getting crude oil or getting gold. Gold is kind of a reflection of this, peaking from its parabolic peak and starting to roll over. I think that's probably your biggest reason for the strength that we've seen this week. Is we're not so bad in those areas, and as bad as we've been, because there's been a lot of chatter about U.S. equities. Here's long-term bonds. Look at long-term bonds rallying all week. Remember how it's been nobody wants to buy U.S. denominated assets, whether it's bonds, whether it's the dollar, whatever, stocks, right? Nobody wants to buy any of it. It's all going down. Well, that wasn't, there was a little bit of a rebound this week. The question is it a trend-changing rebound? And as of right now, that doesn't look to be the case. In fact, looking at this, if I were to go back here to when this all started, the sector rotation here. So if I were to go back, remember we started this on February the 20th. We hit our peak on February the 19th. So let's go to a sector rotation chart here on February the 20th, going backwards here. So we'll go February the 20th into today. So this is the correction so far. This is how the markets have moved. And you can see, like, going into this week, because remember this is Monday of this week. On Monday of this week, XLK was down 22% from that peak. XLY was down 20% from that peak. XLC was matching the market's return of about a 15% decline off of that peak. And then now they've rallied. They've rallied the most in the last 4 days because they were down the most out of all the sectors. You can see that still you have staples, utilities, real estate. There's still a clear rotation. Now the rotation on a daily basis is turning into like those 3 areas here. Let me bring up the sector ETFs here. So you can see XLY is moving up to the right. XLC is already over there. XLK, excuse me, that's on the monthly chart. Sorry, let's go daily chart. Something doesn't look right here. So here's XLK moving up to the right. And you can see here XLY and XLC still, despite 4 strong days, they're still moving down to the left, right? Let's see, let's just go to a year. Then if I look at, let's look at the weekly version of this. Remember, there still is a clear trend to safety. Real estate, healthcare, utilities, staples. There's still, all 4 of them have the highest momentum out of all the sectors. Materials and energy are the next 2 highest. All 4 of these still have the highest momentum on a weekly basis. The 3 that have the lowest momentum is still XLC, XLY, and XLK. And then you can see XLK and XLY are still moving over to the left. And XLB is still, like those 2 and XLB still have the worst relative strength with staples, utilities, and you can see healthcare is kind of matching XLF and XLC here for that 3rd relative strength. So this is a longer term shift that we're getting into safety trades, into other cyclical areas. That one little bounce of I wouldn't say it's little. I mean, if you look at XLK here, let's take a look at XLK and its rally here. This on a weekly chart. Give me 1 second. Here's the daily chart. Let's look at and then you can see well above its 17-day moving average. In fact, the 8-day is crossing the 17-day. But let's look at the weekly version of this, because remember, this was so bearish. This was the worst sector out of all of them on the rotation graph and on the since February the 20th. Let's go to a 5-year weekly chart. Sorry, my computer is a little slow right now. Might have to get a new computer. There we go. So again, as great as this move has been, coming off of these 20% declines, we're barely above the 8-week moving average, and we're not above the 17, right? You can see over here in March of 2022, we did get above the 17-week, only to see it fail. And then in May, we got above the 8-week, barely, or at least got up to it before it failed into June. And of course, August, we were well above it before it failed. And you can see we're still way below the relative strength there, the 50-day moving average of the relative strength line, with both lines easily below 100. Let's bring this up here, this chart, and then we'll do let's change the symbol. Let's change the symbol up here to XOK SPY, and then let's come down here to the bottom and change it to a weekly chart. So this is the daily, and you can see the daily is starting to show a little bit of strength. It's been pretty oversold on a long-term basis. The CCI is high. The ADX looks pretty good. The RSI is not quite at bullish levels. Strong relative strength with the S&P. We're above the 50-day average, right? We closed today above the 50-day average. Here's the weekly version of that. We closed back above the 200-week. After being below the 200-week, we had such a strong move just to get back above the 200-week, but not anywhere close to changing the trend. Obviously above the 8-week too, but not above the 17-week, and not even close to changing the trend yet. And you can see the long-term trend is still bearish. So, there might be some, positive, and we might kind of go sideways like maybe. I don't think, I think we are correcting an extreme oversold condition. I don't think necessarily that we've had a change in sentiment. I don't think that what caused the correction to start in the first place has been rectified. to the point where now we can just move up to new highs. That we've put whatever that cause was behind us, and we can just keep going up here. That hasn't been the case. In fact, some people have said that we might be past the point of no return, which ultimately would lead to a bear market. That's after a post-correction bounce that fails and all that. But we might have reached the point where we won't be able to. In which case, that Zweig breadth thrust would be literally the first time ever that we don't go up to new highs after getting one, because most of the other corrections that we've had since this index went to 500 stocks have all had one, and they've all gone up to new highs. But again, that May 2022, when we were just a smidgen off, and just that, or on the moving average, or just a day off when the moving average did get up to those levels, just a smidgen there. Otherwise, that would have been our failed one, because of where we were in 2022. Again, looking at that chart, we might have actually been higher. Let's see, May, so right there. So by the time we got to May of 2023, we were just a smidgen lower. So May, this 27th, that's the day that we got it. That's the day 11, right, that we were above 61.5. We closed that day at 415.26. So May 27th of 2023, 2023, May 11th, 27th of 2023, we were at 420.02. So, sorry, I'm all over the place here. 420.02 compared to 415. We were higher, so that actually would have been okay. We would have still been at 100%, but not 20% higher. And obviously, by the time from that level, from that 420 level, 415.26 level, we eventually bottomed out at 356. So by the time of the correction, so it still would have been a higher one. It just wouldn't have been a 24% average gain, which is what we're having. So I think that's probably actually going to be the case this go around, that we're not quite done with this correction. And best case scenario is we might get back to this level 12 months from now, but definitely not taking off to new highs with a 20% gain from here, because that's not what we're seeing. We're not seeing those kind of breakout signals. Even if you look at like the breadth has actually been okay, has been decent. If you look at the breadth here, the McClellan oscillator hit a big number the last couple of days, up above 75, which is pretty extreme. So that's going to start to come down. We've actually already seen it like today, as you saw that with the advanced decline issue. The advancers relative to total issues dropped down to 51% after 3 straight days around 75 to 80. We dropped already back down to 51%. You look at the number of stocks above the 50-day moving average. We're still, at 164, we're above the average, but we're still in bearish territory there. So we haven't changed the sentiment there. You look at the number of stocks above the 200-day moving average. We're above the average too, barely above this average, but we're still way below 200. We're still well in bearish territory. So we haven't changed the sentiment there. The ratio is still at 1. Like we haven't broken through 1 here like we did in 2023 with that Zweig breadth thrust, to where we can really now get going to the upside. So that hasn't happened. The number of, you can see the number of new highs is still abysmally low. Like we haven't got another new surge like we did in 2023. And when we had that Zweig breadth thrust, we had a surge in new highs. That's not the case yet. So we're still not like the breadth and the money flow. I talked about the money flow. That's still not there. We're still not getting, the surge. You can see right there at 60, but again, compared to where we're at right here, like here we closed at 551. Today we're at 550. You can see the volume's nowhere near rebounding enough to get back to that point where price has already gotten back to, even with the nice little rebound we've had the last couple of days in this. So I wouldn't put a whole lot of stock into, unless we can get a follow through next week, I wouldn't put a lot of stock into this move in terms of its bullishness. What we really hope we don't do tomorrow, what we kind of hope the worst case scenario is next week, is we just kind of go sideways. That's what May 2022 did. Like we got that signal, and then we just went sideways for about a week or so before rolling over. So we're, hopefully that's the worst case scenario now, is we just kind of go sideways, that we don't V top as much as we V bottomed here. But again, considering the resistance and these indicators, that's certainly a possibility that we need to entertain next week, as bullish as we've been to get to this point, and not quite strongly bullish enough at the end of the week to break us through this point. All right, well, that brings us to our trade idea of the day, which is actually on JP Morgan. Let's pull up JP Morgan's chart here. If my cursor will actually let me get it. There we go. And let's go to the market forecast chart first. Try this again. Something's going, it's slowing things down here. Let's try this again. There we go. So there is JP Morgan. Again, looks almost exactly like the market itself. Intermediate line's rising. We went from red line to green line, so we're 3% above the moving average, which is pretty good. Obviously enough to get the line to turn higher. Dark green shading with the intermediate line in bullish territory. Not the strongest near-term move, but looking okay there. JP Morgan on the weekly chart. Eventually. There we go. So if I look at, again, transition candle with a green line, never did get a death cross, right, like the S&P. But a transition candle there with a green line. It's a bullish candle somewhat. So, possibility that that's a transition. Excuse me, that's a reversal. If I take a look at its 3 green arrow chart, obviously getting 3 green arrows are above the moving average. The 8 and 17-day are crossing above the 30-day moving average. The MACD is above 0. The stochastics is above 80. I mean, all looking pretty strong here. If you take a look at the some of the other oscillators, however, they're not necessarily confirming that strength. You can see that both lines are below 25 on the positive and the negative lines. The RSI and the CCI are both at neutral levels, right around, well, the CCI is a little bit higher, but it's barely above 120. And then you look at the Ichimoku cloud. There's no strong trend going right now. There's no trend at all going here. We're right at the cloud, but not breaking through it yet. The rate of change is slightly positive. Looking at the Bollinger Bands and the Keltner channels, the bandwidth is on a decline. We are in the upper half, but not the upper quartile. The momentum is positive, but not strongly positive there. The bands themselves inside the Keltner channel. So again, kind of this idea we're not as strongly bullish as maybe we think. So what I decided to do was do an iron condor spread. So I sold, or selling, I didn't fill before the market closed. Had a personal matter to attend to, but we are at the 20 deltas on both of these, and then one strike away on the long. And you can see here, if I put my Analyze tab, put that on the Analyze tab here. Let's just put that on the Analyze tab so you can see that. And put it right here. So there's our trade, and if you look at it on the Analyze tab and put those slices to break even and put those break evens on the chart, then you can see we are centered right on the point of control. Right now we're right at that point of control. We got the low point here below the 200-day moving average, that if we break, we're probably going to retest those lows. But the high point up here, if we break that, we're probably moving up to new highs. We're trending higher. We've broken out of the value area. We're well above moving averages. We're breaking higher. So if we don't and stay in this range, considering that we're already through earnings into May expiration, then that's kind of the point of this trade, that we can get a pretty decent return. If I position size this all the way to the full position size, it's a pretty decent return for our full risk. And that's our trade for today. All right, well, that does it for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forum. Open up any new thread with any questions or comments you have. Reply to anybody else's thread, and let's keep this conversation going in between videos. Again, thank you very much for watching. Remember to subscribe to our YouTube channel. Hit that thumbs up icon. Comment on the video. Join us on MarketScholars.com for free. Follow and like us on Twitter and Facebook as well. Have a great rest of your weekend, everybody. We'll see you all on Monday.